Welcome, everyone. As you're signing on, we will be starting in just about 60 to 90 seconds. So sit back, grab a coffee or a tea, and or simply a glass of water, and we're going to be ready to roll in just a few minutes.
All right, everyone. Welcome. Thank you for joining us for how to get to the 0% tax bracket. I'm Beth Helberg, the Director of Partner Marketing with NAFA. Just a few notes. We're recording this, and if you have any questions, please add them to the comments or use the Q&A button so they can be addressed later. Now, I'd just like to introduce Harlan Accola with Fairway Mortgage. He's the National Reverse Mortgage Director. Harlan, I'd just like to hand it over to you to take over.
Thank you very much. I appreciate that. And we're incredibly fortunate. I'm going to talk as little as possible because we have some very, very important things from David McKnight. You are fortunate to be on this call. More importantly, your clients are fortunate that you are on this call. This is some serious stuff. This is current events. This is as important topic as anything you could be dealing with. Most of you already know David McKnight, and I don't need to go into a long introduction. He's been doing this for 20 years, ever since he got out of Brigham Young University back in 1997. He's been in Forbes, USA Today, New York Times, Fox Business, Bloomberg Radio, Market Watch, CBS Radio, CNBC, Yahoo Finance, NASDAQ.com, Reuters, Investors Business Daily, et cetera, et cetera. He was a focus speaker at the worldwide annual meeting of the MDRT in Toronto, Canada. There's a multiple top of the table qualifier. His best-selling book, The Power of Zero, which we regularly make sure that all of our loan officers read so that they can be of help to you, has sold over 200,000 copies. And the updated and revised version was published by Penguin Random House. It was originally launched back in 2018, finished as the #2 most sold business book in the world. In 2019, Power of Zero was ranked as the #9 best financial resource in the country by Forbes. This book was recently made into a full-length documentary film, also entitled The Power of Zero. We've had loan officers that have rented out movie theaters to show this very important documentary that's about an hour and a half long. He's the president of David McKnight and Company. He mentors hundreds of financial advisors across the country who specialize in the Power of Zero retirement approach. We've met many of you and understand that we have loan officers that understand exactly what you are doing and how we can work together from the perspective of the reverse mortgages, forward mortgages, and housing wealth. Personally, David and his wife, Felice, have 7 children. So when he's not busy with the business, I guess he's got plenty to do. One of the things that's not in the regular bio that you don't hear before I turn the mic over to David is I look at David McKnight as a prophet. Now, prophet can have a religious connotation, but the definition that I'm looking for is a person who advocates or speaks in a visionary way about a new belief, cause, or theory. We could not be more lucky to have someone that can help us see into the future. If you can see into the future, there's all kinds of things that we can do to be of far more value to our clients. This is something that we talk to all of our clients about. And by the way, Fairway Mortgage does not do any financial sales of life insurance, annuities, assets under management. We rely completely on your expertise and partnering with you as we make sure that the mortgages are in sync with what your plans are, especially in the 4th quarter of life after somebody reaches 62. But this is something that's very important. I understood this and started putting money into life insurance 18 years ago when I knew that I was going to have a reverse mortgage in 2022. I'm now going to be 62. I don't have my house paid off on purpose, but I have a whole lot more wealth in my life insurance. And that is something that is going to be a great thing, not only for myself, but also for my family and my heirs. Without further ado, and make sure, put the questions on. I'll be looking for them, and we hopefully will have just a few minutes at the end to be able to help you out with some of those answers. Thank you, David, for taking the time on your family vacation in Utah. Take it away. We appreciate you being here.
Well, thank you, Harlan, for that warm introduction. And yeah, so if you hear any children screaming in the background, that's I appreciate that explanation ahead of time. So anyway, so this is a presentation that I've given twice at MDRT. I give it about 90 times per year, live and in person in a non-COVID world. That seems to be with the latest Delta variants, I'm wondering how quickly I'm going to be getting back to live presentations, but I'm happy to be here with you virtually. I typically ask a lot of questions of my audience in a live in-person presentation. We won't have the luxury of having that sort of conversation as we go through this presentation, but as I ask you a question, turn it over in your mind and sort of see what you make of it. That said, let's jump right in. Let's start with, let's see here, why is it not working? Let's start with, okay, there we go. First question I have for you is, what is the highest marginal tax bracket in the history of our country? What's the worst it's ever been? Well, the last 2 years of World War II, highest marginal tax bracket was 94%. And that's for any dollar that you made above and beyond $200,000. Now, $200,000 back then was a pretty big deal. It was about $3.2 million in today's dollars. Can you even think of anybody back then that made that type of money? Well, there was an actor who later became a politician. Can you think of who that was? That's right, Ronald Reagan. If you studied Ronald Reagan's biography, he talks about how he never made more than 2 movies in a year. Reason being, he made about $100,000 per movie. And any dollar he made above and beyond $200,000, he only kept 6 cents on the dollar. And truth be told, he didn't even get to keep the 6 cents. Who do you think got the 6 cents? That's right, the state of California, to pay for state tax. So it literally didn't even make sense for Ronald Reagan to work past the month of June. Well, let's fast forward to the decade of the 70s. What was the worst federal marginal tax bracket you could pay throughout the entire decade of the 70s? Easy to remember. Throughout the entire decade of the 70s, worst federal marginal tax bracket you could pay was 70%. Once again, for any dollar you made above and beyond $200,000. Now let's fast forward to today. What is the worst federal marginal tax bracket you can pay today? The tax rate at which Bill Gates pays taxes on most of his earned income? That's 37%. So here's my question for you, and this is not a trick question. How does 37 stack up against some of these tax rates we've experienced in the past? What do you think? Well, you may be thinking, wow, it's pretty low by comparison. It's interesting you should say that because, like I said, I give this workshop all across the country, rooms full of people routinely ask the question, how bad are taxes today? And what do you think they say? They say terrible, horrible, as bad as they've ever been. What's the truth? The truth is that tax rates today are just about as low as we've seen in our lifetime. However, something's going to happen to that tax rate January 1st, 2026. Is it going to go up or is it going to go down? It's going to go up. What's it going to go up to? It's going to go up to 39.6. And guess what, folks? In order for that to happen, all Congress has to do is nothing. Is Congress pretty good at doing nothing? You bet they are. Well, it's 39.6 enough to keep me awake at night. Well, 39.6 is what tax rates were throughout the entire decade of the 90s. How was the stock market doing in the 90s? Was it doing okay? You bet it was. It was doing great. In fact, if you dropped $100,000 into the S&P 500 in 1990, took a nap for 9 years, woke up in 1999, what would that $100,000 have been worth? It would have been worth $600,000. In other words, your money would have sextupled during the decade of the 90s alone. And that's under these kind of tax rates. So again, not enough to keep me awake at night. The real question I have for you, however, is this. What is likely to happen to tax rates beyond 2026 as we move forward in time to 2028, 2030 and beyond? What does your gut tell you? Are tax rates down the road likely to be higher or lower than 39.6? Well, for those of you who think higher, and I'm with you, my question for you is why? What will we be spending money on as a country that could literally force tax rates to go up? What are the big ticket items? Let's talk about it. Well, first and foremost, we should be talking about the debt. And you know what? It's not so much the debt, it's the interest on the debt. It's the cost of renting the money that we've already spent. And what's driving that debt? We got Medicare, we got Medicaid, we got Social Security. Here's the CARES Act. We had to borrow $6 trillion to build a bridge across the abyss in our economy created by COVID-19. It normally takes us 6 years to accumulate that kind of debt. So it's sort of increasing at breakneck speed. Here's one for you, pensions. The other day I was talking to a lady. I said, hey, what happens to your pension if your company goes broke? She says, don't worry. no matter what happens to my company, the federal government guarantees I will always receive 2/3 of my pension every year till I die. Folks, that is what we call an unfunded obligation. What's an unfunded obligation? It's a promise the federal government's made that they can't afford to keep. Some experts say that what we've actually promised and we can't afford to pay is about $125 trillion. Well, there's a very famous economist by the name of Dr. Larry Kotlikoff out of Boston University. He's a foremost expert in the world on what we call fiscal gap accounting. And what he does is he projects out over the next 75 years what we have promised to pay for things like Social Security, Medicare, Medicaid, interest on the national debt. He's projected out over that same time period what we can actually afford to deliver under today's tax rates. He says, you know what? If there's a difference between those two numbers, then your country has a fiscal gap. And that's your true national debt. He says a true national debt's not 28.5 trillion. It's not even 125 trillion. He says it's much closer to $239 trillion. What does that mean? That means that we would have to have $239 trillion sitting in a bank account today, earning treasury rates to be able to deliver on everything that we promise that we can't afford to pay. And the list goes on and on and on. But if you had to pick two things on this list that will make debt go up more than any two other things, which two would you pick? Well, if you said Medicare and Social Security, you'd be absolutely correct. Let's see if we can sort of wrap our brains around why. I'm going to open up a brief parentheses just on Social Security alone. Here's a quick quiz for you. When was Social Security invented? When did they first roll it out? What year? It was 1935, linchpin of the New Deal, hallmark of the Roosevelt administration. And when Social Security first started out, how many workers were putting money into the program for every one person that took money out? What did that ratio look like? Yeah, 42 to 1. So you had 42 workers putting money in for every one person that took money out. And back then, how old did you have to be to draw on Social Security? Well, you couldn't touch it until age 65. Anybody want to take a stab at what the average life expectancy was back then? It was only 62. They didn't even anticipate that the average person would live long enough to ever draw on Social Security. If you were lucky enough to make it to 65, how long did you draw on Social Security before you tipped over dead? Only a couple of years. So in summary, when Social Security first started out, you had all these people putting money in, hardly anybody taking money out. And when they took it out for 2 years, then they died. Folks, was Social Security pretty solvent when it first started out? You bet it was. It was set up to last forever. And then something happened. Soldiers came home from World War II and they started to do something at a rate at which they'd never done it before. What did they start doing? They started to have babies. In fact, if you look at demographic trends over the last 100 years or so, it looks a little bit like this. You start off at the turn of the century with what we call the Henry IV generation. These are our World War II vets. What did Tom Brokaw call these folks? That's right, the greatest generation. They were followed up by what we call the silent generation, still sort of reeling from the Great Depression. And then what do we call this big statistical anomaly in the middle here? We call these the baby boomers. So as it turns out, my mom was one of the very first baby boomers. She was born January 17th, 1964. Last baby boomer was born 1946. Last baby boomer was born 1964. So we had 18 years of unprecedented procreation. How many baby boomers do we have in our country today? Try 78 million. It's 25% of our country, or at least of our voting bloc. You'll see why that's important here in a second. Now, did they have a few children of their own? They had a few. Okay, we call these Generation Xers. I am a Generation Xer, and then we had children of our own. We call that Generation Y. I've got 7 kids. That's exactly what I asked myself in the middle of the night. Little 7-kid humor for you there. Now, as you look at this chart, did baby boomers, these folks in the middle, have nearly as many children as their parents did? And the answer is no, not even close. They had almost 30 million fewer children. So if you were to ask yourself today, how many workers are putting money into Social Security for every one person that takes money out? What does that ratio look like today? It's a little bit less than 3 to 1. In another 10 years, it's going to be closer to 2 to 1. And what's the earliest you can draw on Social Security today? Well, you can touch it as early as 62. And if you start at 62, how long will you continue to draw on Social Security before you tip over dead? Try 23 years or until age 85. Folks, is Social Security today just a little bit different than when it first started out? Sure, it started off as insurance against living too long, and it slowly morphed into a pension program that covers us for nearly a quarter of our lives. Well, folks, how many of you guys have ever heard of a guy named David Walker? David Walker was what we call the Comptroller General of the federal government. What does that mean? That means he was the head of the Government Accountability Office. He's the nation's chief auditor. He's on the board of Social Security. Basically, he was the CPA of the USA. And he did that for 10 years under Bush and Clinton. The reason I'm telling you this is because David Walker knows more about these numbers than just about anyone else on the planet. And he took one look at the books and he said, hey, we have promised way more than we can afford to keep. You think Social Security is bad? He says Medicare is 5 times more expensive. He said to be able to deliver on these 2 promises alone, said this in 2008, said we would have to double taxes immediately. He said, you don't have to double taxes immediately, but for every year that you postpone doubling taxes, the national debt will grow by $2 trillion per year on average, each and every year, until we hit this magical moment in our country when we have $53 trillion of debt. Folks, what's wrong with a country that has $53 trillion of debt? Well, did you know that if we had $53 trillion of debt, then all of the revenue flowing into the US Treasury at that point under today's tax rates would only be enough to pay the interest on all that debt, let alone any principal, let alone a single dollar for Social Security, Medicare, Medicaid, or anything else we listed on the screen. David Walker was so concerned about this that in 2008, he resigned and started to crisscross the country, raising the warning cry to whoever would listen. And in 2010, he wrote a book called Come Back America, in which he diagnosed the problem. And he appeared on NPR to talk about his book. And he told the radio show hostess, he said, hey, look, tax rates have to double or we're going to go broke. And she didn't believe him. So he says, look, I can give you one 4-letter word to explain why tax rates have to double. And she couldn't guess what it was. So they opened up the phone lines and people started to call in. And nobody could guess the 4-letter word that explains why tax rates have to double. They heard debt, kids, jobs, wars. One guy even said health. They said H-E-A. They said, no, it's not that one. So what is that 4-letter word that explains why tax rates have to double? It's math. Math is a 4-letter word that explains why tax rates have to double. What did David Walker mean by math? Well, basically what he's saying is, look, if this is what you're spending and this is what's coming in, you can either double what's coming in, cut in half what's going out, or some combination of the two. I remember I was giving the same presentation 2 days before midterm elections in 2009 in a little city called Fond du Lac, Wisconsin. And when I was done with my presentation, everybody came up to me and said, Dave, who should we vote for? Who should we vote for? And I never felt so powerful. And I said, you know what? It doesn't matter who you vote for, because whoever gets elected is going to inherit a math problem, the solution to which involves either doubling taxes, reducing spending by half, or some combination of the two. All right, let's get serious, folks. How many guys have ever watched The Roadrunner? Well, if you have, you know exactly who is always trying to kill the Roadrunner. So it's the coyote, right? Wile E. Coyote, super genius. Well, a couple of years ago, I was watching The Roadrunner. And in this particular episode, the coyote was trying to kill the Roadrunner. He was building a bomb with which to do so. And what company makes his bombs? That's right, Acme. So he's building a bomb made by Acme inside a shed that was also made by Acme. And he was so focused and intent on finishing this bomb that he didn't realize that the Roadrunner had pushed his shed onto a train track. Maybe you've seen the episode. And he was so focused and intent on finishing this bomb that he also didn't realize until the last possible moment that there was a huge freight train bearing down on him. Now, very important question, most important question I'm going to ask today. If you found yourselves on a train track with a huge freight train bearing down on you, what would you do? Well, you'd probably jump out of the way. Well, when the coyote sees this huge freight train bearing down on him, instead of jumping out of the way, what does he do? He simply pulls down the window shade, thinking that the act of doing so would make the problem go away. Did the problem go away? No, there's a huge explosion. And does the coyote ever really die? No, it's frustrating, right? But as the smoke and fire cleared away, you could sort of see him limping off screen, very much the worse for wear. Well, folks, why did we gather here today to talk about the Roadrunner? Well, as Americans who do most of our saving for retirement and what we call tax deferred vehicles like 401ks and IRAs, we have a very real freight train that's bearing down on us. And it's bearing down on us in the form of what? It's bearing down on us in the form of higher taxes. And we got a couple of choices of what we can do about it. We can pretend like the problem doesn't really exist. We can pretend like the math to which David Walker referred doesn't really add up. But isn't that a little bit like pulling down that window shade? Or we can implement some strategies starting right now that can help remove our clients from the train tracks, thereby insulating and buffering them from the impact of higher taxes. So as we go throughout today, we're going to talk about some of those strategies that you can utilize starting right now to get your clients off the tracks. Well, as you know, there's millions of different types of investments out there. There's all sorts of different ways to save money for retirement. But I'm here to tell you that all of those different investments basically fit into only 3 types of accounts. How's that for easy? There's only 3 basic types of accounts within which to save money for retirement. And today, we're going to talk about these accounts in terms of buckets of money. The first bucket we're going to talk about is what we call the taxable bucket, meaning every year as your money grows, you get to pay a tax. What are some examples of some taxable events? These are taxable accounts. These are things you've heard of before. Savings accounts, CDs, money markets, mutual funds, stocks, bonds. You guys get the idea. Now, how can you tell if you have a taxable investment? Well, every year at the end of the year, you get that little love letter from the IRS or from the financial institution. What's that called? It's called a 1099, right? It says, hey, your money grew this much. Now you got to give a portion of that money back to the IRS in the form of taxes. So the 1099 is a tip off. So generally speaking, the growth on the money in this bucket is 100% taxable. Well, if that's the case, why do we even have these types of investments? We have them because they tend to be very liquid. What does that mean? It means you can get your hands on it, which means they make for great emergency funds. What do financial experts tell us about how much money we should have in emergency funds? It's like the one thing they can actually agree upon: 6 months worth of basic living expenses. That said, can you have too much money in this bucket? Yeah, we see it all the time. So what we're looking for in this bucket is just the right amount, and just the right amount is 6 months worth of basic living expenses. Second bucket we're looking for is what we call the tax deferred investment, meaning every year, meaning you don't pay taxes on your money as it grows. When do you pay the tax? At the very end, when you take the money out. Common examples, things you've heard of before. Again, 401ks, IRAs, 403bs, 457s, SEPs, simples, annuities. You guys get the idea. Now, there's all sorts of different rules that apply to these investments, but generally speaking, they all have 2 things in common. First thing they have in common, generally speaking, is when you put money in, you get a tax deduction. So for example, if you make $100,000 per year and you put $10,000 into your 401k, what's your new adjusted gross income? That's right, $90,000. The second thing they have in common is the manner in which they're taxed upon distribution. Now, the IRS has a special word that they use to characterize the income that you take out of this bucket. What do they call this income when you take it out? They call it ordinary income. Ordinary income. So what does that mean? That means that when you take money out of your, when you put money into your 401k, all you really did is defer the receipt of that income until some point much further down the road. And when you take the money out, at what rate are you taxed? Well, whatever tax rates happen to be in the year you take that money out. So folks, isn't that a little bit like going into a business partnership with the IRS, and every year the IRS gets to vote on what percentage of your profits they get to keep? Does that sound like a good business partnership to anyone? So you could have $1 million in your IRA, but unless you can accurately predict what tax rates are going to be in the year you take that money out, do you really know how much money you have? And the answer is no. Is it hard to plan for retirement if you don't know how much money you have? The answer is yes. So that's the tax deferred bucket. Now, the third bucket has all sorts of different names. Some people call it tax advantage, some call it tax preferred, some call it tax exempt. Me, I call it tax free. It's chapter 4 of my book, The Power of Zero, tax free bucket. Now, there's all sorts of different investments out there that masquerade as tax free, but I'm here to tell you, to be truly tax free, it's got to qualify in 2 different ways. The first way, it's got to really be tax free. When I say tax free, I'm talking free from 3 different types of taxes: free from federal tax, free from state tax, and free from capital gains tax. Well, how many of you guys have heard of municipal bonds, right? We've been told municipal bonds are tax-free. Well, are they really tax-free? Let's take a look at it. Are they free from federal tax? They actually are free from federal tax, but are they free from state tax? Not always. If I live in Wisconsin and I buy a municipal bond from Illinois, will Wisconsin give me a tax break for that? No, because I'm not benefiting the municipality in which I live. And let's say I don't want to put all my eggs in one basket. So I buy a mutual fund of municipal bonds, and that mutual fund appreciates in value and I sell it at a gain. Will I pay capital gains tax? You bet I will. So here we have an investment that we've been told is tax-free that isn't truly tax-free. The second thing I'm looking for in a true tax-free investment is distributions don't cause Social Security taxation. Folks, how many of you guys have ever heard of a phrase called provisional income? Provisional income. If you haven't heard of provisional income, don't feel badly. I asked the same question to 100 CPAs a couple of years ago. I said, have you guys heard of provisional income? How many of those 100 hands you think went up? Only two. Only two of those CPAs recognized the phrase provisional income, which is scary because what's provisional income? Provisional income is the income that the IRS tracks to determine if they're going to tax your Social Security. What counts as provisional income? Well, any 1099s coming out of your taxable bucket counts provisional income. Any distributions at all from your tax deferred bucket counts provisional income, and 1/2 of your Social Security count as provisional income. So the IRS adds all this provisional income up. And if it's a single person, it adds up to more than 34,000, or if it's a married couple, it adds up to more than 44,000, then guess what? Up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. Let me put that into perspective for you. Let's say that because of your distributions from the tax deferred bucket, you have a $5,000 hole in your Social Security. Let me ask you a question. How do you think most Americans go about plugging that hole? That's right, by taking more money out of their 401ks and IRAs. So here's a math question for you. If tax rates went up to 50%, like David Walker's predicting, how much money would you have to take out of your IRA or 401k to be able to pay that 50% tax to the IRS and then be left over with $5,000 with which you can then plug the hole in your Social Security? Well, what's double 5,000? It's $10,000. Folks, why do I even bring this stuff up? I bring it up because I've done the math 100 times in 100 different ways and 100 different clients. And this is what I have concluded. I have concluded that when your Social Security gets taxed, you run out of money 5 to 7 years faster than people who do not have their Social Security tax. Why? Because the act of compensating for Social Security taxation forces you to spend down all your other assets that much faster. All right. Everybody pretty much in a good mood by now? All right. Well, what I want to do at this point is I want to just give you a little case study. Okay. Give you a little scenario. Now, this example is not going to fit any of your clients perfectly, but I can guarantee that there will be something in this example that applies to just about everyone you come in contact with. So the example I'm going to give you is 50-year-old Mr. Jones, 50-year-old Mrs. Jones. They make $100,000 per year. They want to retire in 15 years. They're obviously very, very happy. Let's take a look at their situation. Now, remember, we've got those 3 buckets. What are the names of those 3 buckets again? Taxable, tax deferred, and tax-free. Let's say between the 2 of them, they have $500,000 in their IRA in their tax deferred bucket. They've got $100,000 in some plain old taxable mutual funds. That's in their taxable bucket. They're putting 10% into their 401k, but they're getting no company match. They're paying $2,000 per year for some term life insurance, and they're contemplating getting some long-term care insurance that's going to cost them $4,000 per year. Well, if this couple were to walk into a traditional tax deferred paradigm financial advisor's office, how would the conversation go? Well, it just so happens I've been training traditional tax deferred financial advisors for the last 17 years of my life. And in the act of doing so, I have sat in their offices and I've listened to them as they've spoken to people like this for the very first time. And here's how the conversation goes. Mr. and Mrs. Jones, congratulations. They always congratulate you. You've done a great job saving money in this IRA. Problem is, last year down the road at XYZ company, you only earned 7%. We think we can get you 8%. So roll all that money over to us. As far as your mutual funds go, that's a great emergency fund. Problem is, last year down the road, you only earned 3%. We think we can get you 5%. So let us manage that for you as well. As far as your 401k with no match goes, keep on doing it. When you switch jobs, give us a call. We'll roll that 401k into the IRA, get everything under one roof, maybe save you some breakpoints, save you some fees. As far as your term life insurance and long-term care insurance goes, gosh, not really what we do, but who are we to say you shouldn't keep doing it? And that is a conversation that I've heard literally dozens and dozens of times. Well, when someone like this walks into my office for the very first time, I see red flags all over the place. For example, I'm not so much concerned with what's in this IRA today. What keeps me awake at night is what this IRA is going to be worth 15 years from now if it grows at 8% per year. What is this IRA going to be worth 15 years from now if it grows at 8% per year? Try 1.6 million. Folks, I know this sounds great, but what's wrong with having $1.6 million in your tax deferred bucket? Well, did you know that if you had 1.6 million in your tax deferred bucket, the required minimum distributions alone would put you on one of the higher marginal tax brackets and literally guarantee that your Social Security would be taxable in perpetuity with all of the compensating spend down that goes along with it? So what we want to do is we want to prevent this IRA from ever getting to 1.6 million. So this begs the question, how do you prevent an IRA from growing? And don't anyone say, put it in the stock market. Well, one of the most common things that we can do, and one of my very favorite tools, is what we call a Roth conversion. Roth conversion simply says that if you have money in your tax deferred bucket in the form of an IRA, you can shift it to tax-free so long as you pay what along the way? So long as you pay taxes at what rate? At whatever rate taxes happen to be in the year you make the shift. So let's say that Mr. and Mrs. Jones convert their entire IRA all in 1 year. They pay 40% tax. How much tax are they going to owe on that Roth conversion? Well, $200,000. Here's the rub. Do Mr. and Mrs. Jones, who are both age 50, have $200,000 just lying around that they can earmark for that tax bill? The answer is no, they don't have the money. So some people say, Dave, that's okay. They don't need to have the money. Just have the IRS withhold the tax from the conversion itself. Folks, what would happen if a couple of 50-year-olds paid the tax on their Roth conversion right out of their IRA? They'd get a 10% penalty. The IRS says, even if you take the money out and you give it right back to the IRS in the form of a tax, if you're younger than 59 and a half when you do so, you will get a 10% penalty. So rule of thumb here, unless you've got a lot of money just languishing in your taxable bucket that you would happily earmark towards a tax on that Roth conversion, I would probably wait until you're 59 and a half before you start thinking about Roth conversions. So this begs the question, is there any other way to get money out of that IRA pre-59 and a half without penalty? Well, at this point, I may bring up that little known section of the IRS tax code. It's section 72, subsection T. In our industry, we call it a 72T. And a 72T says that you can take money out of your IRA pre-59 and a half without penalty, so long as you do it in separate, equal, yearly distributions that last for at least 5 years or until 59 and a half, whichever is longer. These days, a couple of 50-year-olds could take out about 5% per year. So if we do a 72T in that IRA, that's going to give us $25,000 that we can now reposition to tax-free each and every year. All right, let's take a look at these mutual funds. If that's their emergency fund, how do we feel about it? Do they have too much or too little in their emergency fund? Well, if they're making $100,000 per year, how much should they have in that emergency fund? Well, a lot closer to $50,000. So not only do they have too much money in this emergency fund, but they're growing it in mutual funds, which means the problem's getting bigger every year. So we may recommend that they simply take the growth on that account plus some of the principal, shift it from taxable to tax-free year by year, such that by the time they reach 65, they've got the perfect balance. I've done the math on this. That would require an annual shift of $6,000 per year. Folks, how do we feel about 401ks that don't have matches? This is the one thing that Susie Orman, Dave Ramsey, and Clark Howard actually agree upon. The rule of thumb when it comes to 401ks, you put in up to the match, but not one penny above and beyond. You do whatever's required to get the free money, and then you move on to the next best thing. Well, if these folks are trying to prevent their IRA from growing by doing a 72T, yet they're putting money hand over fist into their 401k and they're getting no free money, are those two strategies at odds with each other? And the answer is yes. So we want to recapture that 10% as well. So 10% of 100,000 is $10,000, shift that to tax-free. How do I feel about term life insurance or long-term care insurance? We feel like it's incredibly important to mitigate both of these risks, either one of which can really upset your financial apple cart, but we feel like sometimes there's just a better way to accomplish that. So we may free up that money as well. So all told, we freed up $47,000 per year to be able to reposition it tax-free. So usually at this point, someone will say, hey, Dave, not so fast. You don't really have 47,000 freed up. And I'll say, why not? And they'll say, because some of those strategies you recommended are actually taxable events. And you know what? They're right. The 72T is taxable. And when you put less money into your 401k, that increases your taxable income. So that's also a taxable event. So because of this strategy, we're realizing an extra $35,000 of taxable income per year. Let's call it 30% on the margin. That's $10,500 of additional taxation every year that we do this strategy. Folks, do Mr. and Mrs. Jones here have $10,500 just lying around that they would love to earmark for a tax bill? Not that they would love. And if we say, quit going out to eat, quit going on vacation, pull back the belt a couple of notches just so you can pay that tax bill, will they return my phone calls? Probably not. So we got to find a way to help them pay that tax bill such that we are not encroaching on their lifestyle. So what I may simply recommend is that they pay that tax right out of the $47,000 we just freed up on the previous screen, which means we really have $36,500 per year to be able to contribute to the tax-free bucket. So folks, this is where the rubber hits the road. Where can we put $36,500 per year such that it grows in a truly tax-free way? Well, at this point, I'm going to recommend that they fully fund one of my very favorite tax-free investments, and that's what we call a Roth IRA. How much money can two 50-year-olds put into Roth IRAs these days? $7,000 each for a total of $14,000 per year. By the way, why do I like Roth IRAs so much? I like Roth IRAs so much because they are truly tax-free. So long as you're 59 and a half when you take the money out, you don't pay any of those taxes we talked about, state, federal, capital gains. And when you take money out of your Roth IRA, it does not count as provisional income. It does not count against the thresholds which cause Social Security taxation. Roth IRAs are truly tax-free. By the way, when I say Roth IRAs, I'm talking to any account with the word Roth in front of it. It could be a Roth IRA, Roth 401k, Roth conversion. They are all truly tax-free. Okay, so we put $14,000 per year into that Roth IRA. That leaves us with $22,500 per year. Where can we put $22,500 per year such that it grows in a truly tax-free way? Well, at this point, I may recommend a bucket of money that gets treated differently for tax purposes than anything else we've talked about so far. What happens with this bucket is you put money in. As your money grows, your bucket begins to fill. Only the IRS says that the growth on the money in this bucket is going to be treated under a different section of the IRS tax code than anything else we've talked about so far. What does that section of the IRS tax code say? It says that you can touch this money pre-59 and a half without penalty. Can you do that on your IRA or 401k? No, you cannot. They're going to tell you that as your money grows, you receive no 1099s. What does that mean? That means no tax as your money grows. Then they're going to tell you that when you take the money out, if you take the money out the right way, we know that's by way of a loan, that it is not going to show up as reportable income on your tax return. So what does that mean? Tax-free distributions, and it does not count as provisional income. They're also going to tell you that there are no contribution limits. What did we say were the contribution limits for the Roth IRA? $7,000 each for a total of $14,000 per year. Folks, I've got clients that do $50 a month, and I've got clients that do $200,000 per year, and everywhere in between. There are no limits on how much you put into this bucket. They're also going to tell you that there are no income limitations. Let me ask you this. Can Bill Gates do a Roth IRA? The answer is no. You start making north of $208,000 in modified adjusted gross income, you can no longer do a Roth IRA. Guess what? That rule does not apply to this particular bucket. And they're also going to tell you that if history serves as a model, there may be no legislative risk. What does that mean? That simply means that if history serves as a model, it should somewhere down the road, they change the rule on this bucket. They simply say, hey, whoever has the bucket before the rule changes gets to keep it and continue to put money into it under the old rule for the rest of their lives. We call that a grandfather clause, right? So usually at this point, people say, well, gosh, Dave, this is like the alignment of the stars. This is like the perfect investment. Why not just put all my money into there? Well, first of all, is it ever a good idea to put all your eggs into any one basket? The answer is, of course not. Not only that, but the IRS says if we're going to give you the benefit of an unlimited bucket of tax-free dollars, we're going to require that there be a cost of admission. We're going to require that there be a spigot attached to the side of that bucket through which flows on a monthly basis some expenses. And what do those expenses go towards? They go towards the cost of administrative fees. Life insurance company has to keep their doors open, but it also goes towards the cost of term life insurance, annual renewable term life insurance. Well, let me ask you this. If your house is paid off, your kids have moved out, you're rapidly approaching retirement, is term life insurance really all that high on your wish list? And the answer is no. Just usually right about now why people start dumping their term life insurance. And the companies that sponsor these programs recognize that. So they've done something to sweeten the pot. They simply say that should somewhere down the road you need long-term care, they will give you your death benefit while you're alive for the purpose of paying for long-term care. Here's an example. Let's say you got a death benefit of $400,000. You wake up one day, you can no longer feed yourself, bathe yourself, transfer yourself, any 2 of 6 activities of daily living. You can find one doctor to write one letter to that effect. They will start sending you 25% of that death benefit, or $100,000 per year every year for 4 years, for the purpose of paying for long-term care. Now, they may discount that number slightly based on your age in which you receive the benefit, but the point is this: they're willing to give you your death benefit while you're alive for the purpose of paying for long-term care. Now, let me ask you guys a question. How many of you guys have ever looked into traditional long-term care insurance? First of all, is it cheap? No, it's getting more and more expensive all the time. Can it be hard to qualify? Sure, you might live to be 120, but if you have a bad back, a bad knee, a bad hip, you may not even get accepted. And what happens if you pay for 30 years and die peaceful in your sleep, never having used it? Are they going to send you all your money back at the end? And the answer is no. It's going to go to pay for someone else's benefit. And that can be a source of heartburn for a lot of different people, because nobody wants to pay for something they hope they never have to use. Why is this different? This is different because if you die peaceful in your sleep 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably your children. So there isn't that sensation of having paid for something you hope you never have to use. By the way, what do we call this bucket? Okay, it's chapter 5 of my book, called Cash Value Life Insurance, called Permanent Life Insurance. This could be an IUL, this could be whole life, this could be a VUL. Me, in my book, I call it an LIRP. What does that stand for? It stands for Life Insurance Retirement Plan. Why life insurance? Because the IRS says in order for this bucket to work, you gotta be willing to pay for some life insurance. You gotta have a need for life insurance. Why retirement plan? Because one of the ancillary goals of this bucket is to build money up so that somewhere down the road you can take money out and spend it on your lifestyle at a period in time when tax rates are likely to be dramatically higher than they are today. All right, before we go any further, I've got a very important question to ask, and it's this: if you could be in any tax bracket of your choosing in retirement, which tax bracket would you choose? Well, if you're anything like me, and you know the name of my book, you probably want to be in the 0% tax bracket. Well, if what Mr. and Mrs. Jones want is to be in the 0% tax bracket, tell me how we're doing so far. They're going to have money coming out of their Roth IRA. So long as they're 59 and a half when they take the money out, will they pay tax? The answer is no. They're going to have a lot of money coming out of their LIRP, regardless of how old they are when they take the money out. And as long as they do it by way of that loan, will they pay tax? The answer is no. Now, let's go back to that IRA. You guys remember that IRA? The goal of doing the 72T was simply to prevent that IRA from getting any bigger. Well, if we did a good job of preventing that IRA from getting any bigger, how much money should still be in that IRA by the time Mr. and Mrs. Jones reach 65? That's right, $500,000. So here's my question for you. If at age 65, Mr. and Mrs. Jones have $500,000 in their IRA, is there any way that they can take money out of that IRA, spend it on their lifestyle, not pay tax, and it's got to be legal? Well, remember, if you retire today, absent any other deductions, the IRS is going to give you a deduction. They call that the standard deduction. What does that mean? That means you can realize income from any number of sources up to $25,100 without paying any tax at all. Now, does the IRS index this number to keep up with inflation? Historically, they have by about 3% per year. So by the time they reach 65, their standard deduction could be closer to $39,100. So here's my question for you. If at age 65, their standard deduction is $39,100, how much could they take out of that IRA without paying any tax at all? That's right, $39,100. So here's the moral of the story, folks. So long as you only take out up to whatever your standard deduction happens to be in any given year, you now have an IRA that is 100% tax-free. And if you have no tax, and no tax, and you could stay below your provisional income thresholds, might require some Roth conversions a little bit later on, but if you can stay below your provisional income thresholds, what do you suppose happens to their Social Security? That's right, no tax. If you have no tax, what tax bracket does that put you in? That's right, 0%, folks. Why do I make such a big deal about being in the 0% tax bracket? Well, if we can't get you to the 0% tax bracket, what's the very next best tax bracket? And don't anyone say 1. That's right, it goes all the way up to 10. Throw in another 6% for state, now we're talking 16. And if what David Walker says comes true, and tax rates have to double to keep our country solid, what happens to that 16? All of a sudden, we're looking at 32. And then all of a sudden, second place isn't looking all that great. Now, I love it when things make sense conceptually, but I love it even more when things make sense mathematically. So what I did for these folks is I did what's called a before and after comparison. You guys have seen the diet photos before, after. Well, did you know you can do the exact same thing with your retirement projection? So what I did was I said, hey, if Mr. and Mrs. Jones here, the very couple we've been talking about, have never met me, and they kept on doing exactly what they were doing, how much money would they be able to spend after tax? And according to my math, they'd be able to spend just shy of $4.4 million after tax. And I don't know what you're thinking. That sounds like a lot of money. It is a lot of money. The problem is they run out of money at age 85, at which point they can either die or move in with their kids. Conversely, if they do everything we've talked about, we get them the 0% tax bracket, get their Social Security tax-free, mix in a little LIRP, they can now spend almost $8 million. They never run out of money. They still have 1.4 million left over at the end. Now people look at this, they say, Dave, why is there such a big difference between these two columns? And you know how I respond? I say, look, when you make little tiny strategic changes midway through your life and you amortize those changes out over a lifetime, guess what? There can be a massive quantum difference on the back end. More importantly, what happens to the blue column if tax rates double? Does it get bigger or smaller? It gets smaller. What happens to the gray column if tax rates double? It stays exactly the same. Why? Because if you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. Folks, that is what we call the power of 0. Well, usually at this point, I get a couple of different questions. And the number one question I get when I'm giving this presentation to members of the general public, the number one question I get is, hey, Dave, am I too old to get to the 0% tax bracket? And I usually respond to that question the following way. Throughout 2018, filmmaker Doug Orchard and I crisscrossed the country interviewing all of the most important experts in the nation on the national debt as it relates to the future of tax rates. Take a listen to what they had to say.
The truth is the federal government has lost control of the budget.
Instead of paying for all the new initiatives, whether they're tax cuts, spending increases, all sorts of things that we like, the government's just putting it all on the national credit card. And as a result, our national debt is just going up and up and up. And it's growing faster than the economy. And that's when you know you have a real problem.
Everything is going to be squeezed out of the budget. There won't be anything left.
The road we are on is a perilous one that ultimately leads to the bankrupting of our country.
So we have a crisis on our hands.
All Congress has to do for this whole situation to come to a head is nothing. Because every year that they do nothing makes the problem even more unsolvable.
We don't seem to have the ability to get along and find common ground.
Is the government trying to trick you right now? And the answer is very simply yes.
So why is this being swept under the rug? Why is nobody talking about this?
Probably because it's not popular.
So I've actually been traveling around the country for about 4 years now, taking the power of 0 message to different groups.
When you cut taxes on current generations, you are simultaneously raising them on future generations.
It is all driven by spending. Once we have spent a dollar, we've already decided to tax it. The only question is whether we tax it now or we borrow it now and tax it in the future.
So to make up for the liabilities that we're incurring with all the promises we've made in social insurance programs, we're going to have to increase substantially the tax rate and perhaps even double it.
Now, precisely how high it's going to be, you know, there's a lot of room to debate, but people will have to pay more taxes.
People's retirement savings are at risk of future higher taxes.
Well, qualified plans really do two things. They defer the tax and the tax calculation. Now let that run past your brain real slow.
I'm driven by trying to help as many people as I can avoid this disaster that's going to come up in retirement when taxes go up and the market goes down. What are these people going to do if they haven't planned ahead of time?
All right, so all of these experts are reading the same music and they're singing the same song. They're saying if we don't change course immediately, that 10 years from now, tax rates are going to have to be dramatically higher than they are today just to keep our country solvent. Some of them even use the D word as it relates to the future of tax rates. Tax rates will have to double or we go broke as a country. So the real question is not, are you too old to get to the 0% tax bracket? The real question is, if 2030 rolls around and tax rates double, will you look back on the year 2021 and say, why did I not take advantage of tax rates while they were historically low? The second question I get is, can you be in the 0% tax bracket and still be a good person? Sure. We're not suggesting that Mr. and Mrs. Jones not pay tax. In fact, the cost of getting the 0% tax bracket is you gotta be willing to pay a tax. We're simply suggesting that when given the choice between paying taxes at today's historically low tax rates or postponing the payment of those taxes till some point much further down the road, you're probably better off paying them today. And the third question I get is, hey, Dave, how come I've never heard of this stuff before? And I would submit that your clients have heard of just about everything we've talked about today. Maybe not quite in this combination, but they've heard of just about everything we've talked about. The only thing that's new for some folks is this idea of the LIRP. And all we're doing that the LIRP is the opposite of what most people do when it comes to life insurance. What do most people do when it comes to life insurance? They get as much death benefit as they can for as little money as possible. What do we call that? Call that term life insurance. Here we're doing just the opposite. We're getting as little death benefit as the IRS requires of us, and we're stuffing as much money into it as the IRS allows in an attempt to mimic all of the tax-free benefits of the Roth IRA without any of the limitations. Why else haven't you heard about this? Well, you got to ask yourself how most major money management institutions make money. How do most major money management institutions make money? They charge you a fee. Let's call it 1%. So let's say they're managing $1 million of your dollars in the tax deferred bucket and they're charging 1% per year. How much are they making off you per year? $10,000. No big deal. This is how I make money. This is how a lot of people on this webinar make money. But here's the rub. Should they persuade you that tax rates in the future are likely to be dramatically higher than they are today, you might just feel compelled to shift that money to tax-free. And if you shift it to tax-free, what are you going to have to pay along the way? Taxes. Let's call it 30%. So you pay 30% tax, you're left over with $700,000. If they're still charging you 1%, how much are they making off you per year now? Only $7,000. Didn't they just experience a pay cut for persuading you that tax rates in the future are likely to be dramatically higher than they are today? And for that reason alone, most major money management institutions don't want to touch this conversation with a 10-foot pole. In fact, in some cases, they actually forbid their advisors from even bringing it up. Me personally, I don't care how much money you have. The only thing that matters to me is how much you get to spend after tax. That is the only number that really matters. All right, so for those of you who are taking notes, I got 5 different takeaways for you. Takeaway number 1, tax rates in the future are likely to be dramatically higher than they are today, folks. Mathematically speaking, we have passed the point of no return. Takeaway number 2, the only way to truly insulate yourself from the impact of higher taxes is to get to the 0% tax bracket. Why? Because if you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. Takeaway number 3, it's nearly impossible to get to the 0% tax bracket by relying on just one stream of tax-free income. Folks, I've been doing this for 22 years. I've helped put thousands of people on the road to the 0% tax bracket. And let me tell you this, you can't get to the 0% tax bracket by simply contributing to a Roth IRA. You can't get a 0% tax bracket by simply owning an LIRP. To get to the 0% tax bracket typically requires between 4 and 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. Takeaway number 4, we know that as of January 1st, 2018, taxes went on sale. But what we also know is that that sale has an expiration date, January 1st, 2026. What does that mean? That means that every year between now and then represents a little mini window of opportunity within which to take advantage of historically low tax rates. And every year that goes by where you fail to take advantage of historically low tax rates is potentially a year beyond 2026 when you could be forced to pay the highest tax rates you're likely to see in your lifetime. And the last takeaway that I want you to really internalize is this: all of this is really, really good news for you and your clients and prospects. Let me illustrate with a story. A couple of months ago, a lady comes up to me at the end of my presentation. She says, "Hey, Dave, thanks a lot. Now I'm in a really bad mood." And I said, "Well, why are you in such a bad mood?" And she says, "Because I got all my money in the tax deferred bucket." And I said, "Let me see if I understand this right. You contributed money to your tax deferred bucket at a period in time when tax rates were a lot higher than they are today. You got a deduction at those higher rates for doing so. And you now have a 5-year period of time during which to take advantage of historically low tax rates so you can get those assets systematically shifted to tax-free, so that by the time tax rates potentially double over time, you've done all the heavy lifting, you can now take those dollars out tax-free." I said, "Is that why you're in such a bad mood?" And she says, "Well, gosh, Dave, I never really thought about it that way." So here's my question for you. How is this story going to end for your clients? Well, I would submit that so long as you take advantage of historically low tax rates, as long as they take advantage of the next 5 years of historically low tax rates, that they get to determine how this story is going to end for them. All right, a couple of things. People like to say, "Hey, Dave, how am I supposed to bottle this up and unleash it on my clients?" And so long as we can agree that this is an important, timely presentation, the answer is, how do you convey this to your clients? Well, for those of you who have read The Power of Zero, you know that that book follows this presentation pretty closely. If you are looking to get these books in bulk, you can do so at davidmcknightbooks.com. You will never get them cheaper than you will in the next 24 hours. Why? Because I am giving you an offer that if you order at least 10 copies of The Power of Zero, you will get free shipping and you will get bulk discounts, but you have to do that in the next 24 hours. So any books that you buy in the 24 hours, we will take account of that, and we will actually deduct the cost of shipping from your order. It's going to show up on your screen, but we will deduct it on our end. So go to davidmcknightbooks.com. Also, we have a live Power of Zero boot camp. If you want to learn how to internalize these principles into your practice, it's August 27th. It doesn't cost you a dime. It's 8 a.m. to 5 p.m. Hyatt Regency O'Hare, Chicago. You can register at powerofzero.com/bootcamp. You do have to be an independent producer to come. You can't be a career agent or a captive agent. You do have to be an independent producer, and you do have to have a verifiable production of at least $150,000 to be able to get in. And then finally, if you want to learn more about me, you can do so at powerofzero.com. You can follow me on Instagram or Twitter. You can watch that documentary for free, by the way, at thetaxtrain.com, and take a listen to my podcast that comes out every Wednesday on the Power of Zero show. All right, we got 3 minutes left, Harlan, so I'm going to pass it back to you.
Thank you, David. If that doesn't make a difference in a lot of people's lives, I don't know what will. And obviously, David just talked at speeds of up to 800 words a minute, I think it was. And so but it's impossible to cover everything. Why does a mortgage company sponsor David McKnight coming on? Because we understand that the wealth in the home has to do with that. And our people, if you send a client to the average bank, they're going to tell them, no, don't mess around with cash value life insurance. That's just not a good idea. Our people already know the power of cash value life insurance, the power of the LIRP, the power of annuities, and we understand how important that is. We don't sell them. We don't compete with you. We simply work together and come up alongside. One of the things is we can also give money out of the home to pay for some of the Roth conversion taxes to accelerate some of these things. And in the last couple of minutes that we've got together, I answered most of the questions because I've heard you a lot, David, and listened to your podcast. In fact, I've been on your podcast. Thank you. And so I answered most of the questions. But one of the things to kind of connect the dots here, if you can kind of share a little bit about what you thought before in the past about reverse mortgages and retirement planning and what you think now, because that was a little bit of a change in your thought process.
Yeah. And you appeared on my podcast a year or so ago, and we talked about this. The reverse mortgages, always had that that stigma, right? Historically, that you're taking the most valuable asset that somebody has and you're spending it down so they have nothing left. And what I realized is really kids do not want to inherit their parents' home. Only when they get surveyed, only 1% of them want to inherit their parents' home. They would much rather inherit cash. And so what families are doing is they're spending down their liquid assets during their retirement, and then they're leaving the home to their children and the children just want to get rid of it as soon as they can. So they're going to sell it at a fire sale, which means they're going to lose money in the process. Why not, instead of spending down your liquid assets that get transferred so easily to the next generation, why not spend down your home during the process and then leave all of that cash to the next generation, where they don't have to sell it at a fire sale, they can use it and spend it at their leisure. To me, that sort of an idea really resonates with me very, very profoundly. And so I am a big fan, once you get to age 62, of seriously taking a look at this tax-free alternative. And it fits very, very nicely with everything that we've talked about today.
Well, thank you for that, David. And, one of the, Ann mentioned, doesn't this time kick the tax liability down the road to your heirs? It does not. My kids are not going to inherit a house, which might have a problem with capital gains based on what they're talking about in Congress right now. My kids are going to get a life insurance check. They don't want my house. All 4 of them have a house. So what happens is my children are going to get a life insurance check within a month after I die. They don't have to try to sell the house. They don't have to keep making payments. They don't have to fix it. They don't have to pay taxes. So it is incredibly important that this scenario is understood, that this doesn't just defer taxes, this eliminates the tax liability for you and your heirs. And read The Power of Zero. All of our loan officers have access to it, as well as a documentary. And of course, you can watch it free on his thetaxtrain.com, as you see here. But you can feel free to get in contact with any of our people as to how we work together with your folks to be able to put that together. And as Frank Lehane said, the documentary, prudently used with clients, can not only educate, but inspire action taking. And isn't that what we want? The people need to take action, because there's going to be a lot of people in trouble if they don't do something now. And we know also with inflation and what's happening, it is your job, it is our job to make sure that we make a difference in the lives of our clients. We're right just past the top of the hour. We thank you for taking the time. This will be available for a short period of time on the archive area of NAIFA. We have the Power of Zero book, the Power of Zero DVDs available to you from our loan officers. Simply contact us at the reverse events at fairwaymc.com that I typed into the box there, reverse events at fairwaymc.com. And we will help you put some of these things together. But get the books, order them right now, pass them out to the clients. Your clients deserve to know this information. David, any final thoughts that you have before we finish things off and turn them back over to NAIFA?
I don't think so. Just really appreciate you guys having me.
Well, thank you. You're going to make a big difference in a lot of people's lives just because of what you did today. Thanks for taking time out on your vacation. And a thank you to everyone at NAIFA with the partnership that we have to make sure that we're getting this news out.
Thank you, David and Harlan. We really appreciate it. I know there was some great information shared, and we really appreciate it. And as Harlan mentioned, this will be available via video on our archives page, and we had a great audience today and great questions. So we hope you'll join us again. Thanks.
Thank you very much. Appreciate it again, Dave.